everyone. Today we're going to talk about how much money I risk per trade, specifically because you need to know how much money you need to risk per trade and why to become a consistently profitable trader. And just hearing it once, like in this YouTube video or whatever you may be doing, without any context is not going to help you when you're alone at your computer trying to do this by yourself. So in this video, I'm going to explain exactly what I risk per trade and how I do it. If you don't know who I am, my name is LaKiesha, and I make these videos because I want to help you become a consistently profitable trader. And today we are going to talk specifically about how much I risk per trade, and we're going to talk about Forex and Indices accounts, funded account, and options trade, because I trade all of these different things, and it is all based on price action. And just know that candles are the only thing that matters, not indicators, slack patterns, or any other crap you may have been hearing here on YouTube. On this channel, we focus on education, and that is it. The number one rule of trading, you have to decide what is best for you. So this is my number one rule for me when I am trading, and that is to risk the exact same amount every single time. And mainly because probabilities play in your favor when you do this, especially because you may have heard of win rates of 60, 70, 80%, and these are all probabilities. And when I look at my own trading, depending on which market I am trading, it comes out to be somewhere in this particular range. So that's why I'm using these numbers, and this is very realistic inside of the market. Trading is essentially like an experiment. Is something that you do on a daily basis, especially if you're studying, testing, back testing, forward testing, which is actually taking trades inside of the market, or maybe it's a demo account. But everything you try is hopefully getting you closer to being a consistently profitable trader. And in science, we have a control variable, so something that stays constant, or things that stay constant, and then an independent variable, something that is always changing. So when it comes to trading, you are looking at this like you're testing your trading system. So you need to have all of your variables the same, except for one. That's going to be the one thing that you're changing all the time. And trust me, I'm going somewhere with this for sure. But basically, if you change all the variables at one time, then you're not going to have enough good data to make decisions. That's why you may have heard of people talking about specifically trading and journaling or back testing or something like this, because they're testing out maybe one specific thing that they want to adjust inside of their own trading. Basically, look at this like you're a scientist. You're collecting data every time you take a trade, because all of that data that you're collecting is going to help you become a better trader. This is why engineers like myself and scientists make great traders and teachers. So keep learning on this channel. And if you like what you see, go ahead and give it a thumbs up and subscribe to this channel for more content. And some of the variables in trading that I talked about before are the time of day you trade. This is going to be key. The markets you trade, how much you risk per trade, your setup, your entry method, and so much more. And if you've taken even 10 trades, then you kind of see what sort of things you need to be paying attention to when you actually take a trade. And even if you haven't taken a trade inside of a live market, all of this may seem like a lot, but trust me, it's really not once you do these things over and over and over and over again. Example one, this is going to be an example of why you need to risk about the same amount every time you take a trade, because in the beginning, I was wondering why I was consistently losing. And then I got to a point where I was consistently break even, and now I'm to the point where I'm consistently profitable, where I'm able to withdraw some money every single week into my banking account, and that pays for maybe my cell phone bill or my car insurance or something like that. So whatever bill or thing you want to do with this money that you withdraw, keep that in mind as you go through the rest of this video and through your trading journey, because it's only going to serve as inspiration for you. Here's an example. So say on trade one, you risk $100, you lose $100, then okay, you lost $100. So trade two, you risk $50, you gain a 2-to-1 risk to reward, and then that means $100. But what does this mean for your account? It means that you broke even. And I was in this position so many times. So glad that I'm not in that phase anymore, but going through it is frustrating, even if you're on the losing side. So stay tuned. We're gonna talk more about what you can do to overcome that potentially. So example 2 is risking $100, lose $100. Okay, great. Second trade, risk $100, gain that same 2-to-1 risk to reward. Now you're up $200 and your net is $100. This is going to be profitable. A profitable trade for you because like in the first example, you're only at break even. Here, you made $100. And doing this over and over and over again, based on those probabilities that we talked about in this section, 60, 70, 80% win rate, basically this is going to, over time, you're going to see how you could improve, based on one of these different variables that we talked about here, and then even more that you may discover as you continue to trade either in demo mode or with a small test account in live mode. That's actually what I prefer to do. And that's how I actually got better much quicker. So just getting over the fear of putting live money into the market and just doing it is going to be better. At least that's what it was for me. But of course, you do what you need to do and whatever's comfortable. But just know that growth does not come from comfort zones. So get over it and just try it if it's something that you want to try. Let's talk about this thing. This is the one thing that started me on the path to becoming a consistent, profitable trader. So looking at this example, you can see how the math works out. And of course, throw in any number in here and you can see how that could potentially work out for you. If you like this video so far, there's another video that you should check out that I made, account size that I started with. How much money do I need to start day trading? This is actually a quite common question, in addition to this question right here that I've been asked either from students or potential customers in my business. So go ahead and check out this video. And if you are interested in potentially working with me, then go ahead and check out the link below. Right now, it's chartconfidence.com/call. Learn more about me, see if it's a good fit, and then maybe we can go forward. So when it comes to Forex or indices accounts, typically I risk 1 to 2% of my account size. So that's initially. And then plus, I like to use a scale in method. And basically I use 1% increments of my account size. So typically once or twice. I don't try to scale in 50 times just because I don't want to put that much risk on my account. So let me do a quick breakdown of what that looks like. So, and just know that the scale in method is advanced. So if you're just learning, maybe skip the part that's highlighted here and just focus on the 1 to 2%. At least that's what I did, and that helped me out quite a bit. Here's an example. So say you got $10,000, you're risking $100 to $200 per trade. This is equivalent to 1% or 2% per trade. And then you add another $100 to that, and then add another $100 to that. So that's that scale in piece. And now you're about $300 to $400 into one trade. So like I said, that's more advanced, but that's typically what I do. And just know that there is not always an opportunity to scale in. So most times I'm only risking about 1, maybe 2% at most when it comes to these particular accounts. Or and when I say accounts, I like to designate certain accounts for certain types of trading. So I have an account for Forex, I have an account for indices, and next I have a funded account. So currently I'm funded up to, or funded at 300K, which is cool. I'm not really a big fan of this funded company, which is why I really don't talk about it here on this channel. But when I do use that particular account, I typically use 1 to 2% of the total account size. So just know that this 1 to 2% is in reality 10 to 20% of the allotted loss size inside of that funded account. So if you don't really understand how funded accounts work, basically you do this challenge and then you pass the challenge. Say it's a $100,000 account. And then, okay, great. So it doesn't really mean that you have $100,000 to trade with because it's not actual money. It's usually simulated or like a demo account, but based on your performance, you may get paid out if you do gain on the account. So within those accounts, sometimes depending on the company, it may be a max loss percentage of maybe 8%. So for instance, if you have a $100,000 account, you can't lose more than $8,000 on that particular account, or otherwise your account could be taken away. And if you want another challenge, you have to start all the way over. So in this particular situation, I believe the max loss size is about 10% on this particular, or using this particular company that I am using. So this 100K account, if I risk $1,000 per trade, that's typically what I do. That is 1% of the total amount. So 1,000 is 1% of 100K. Great. But if we look at the allotted amount is really 10K, because if I can max lose 10% of the account, then that's $10,000 on 100K account. So that $100 is really equal to 10% of the total amount that I could lose. So the reason why I do this a little bit differently is because obviously risking 10% of the total allotment is riskier. So I only do this with high probability setups on these accounts. So you may be thinking, well, aren't all of your trades high probabilities usually? And the answer is yes. However, with the funded account, I do make extra precautions or take extra precautions when it comes to putting this money inside of the market, just because of that really, really tight threshold. So pretty much anybody that makes any money from a funded account, they definitely deserve a round of applause, because they have really tight limits. And overall, I just don't think it's designed for people to really make money, especially because of this particular account that I'm using. They changed some stuff in the background, mainly their platform. And I remember taking a trade and it was really jerky. And what I mean by that is I would hit, say the close button, 5 times before it actually closed. And then eventually the software in the background would catch up, and then it would close all the other positions that I had. So it was really difficult to know when I was exiting the market. And in this particular situation, like the numbers wouldn't be correct in terms of from when I hit the exit button versus what actually happened, because I would get slipped, or basically the price would slip quite a bit in this particular broker. So they say they're fixing it. Hopefully it gets better. And if it does, then I'll talk about it on this channel. But until then, I'm not going to recommend something that I don't really recommend or like using at this point. The third thing is options trades. So this I really like, mainly because I'm trying to hold these options contracts a little bit longer than I do for, say indices or funded accounts, just because there's a lot more volume and a lot more money that is associated with these first two. But with this third one, it's typically a little bit less for me. So I typically risk about 10 to 15% of my total account size to take the trade. So let me break this down, because it took me a long time to really figure this out, and nobody was really talking about it. So then the other thing that I do is I don't allow my options contract value to get below 20%. So I'll put value here. So I got a $12,000 account. Let's say I risk $1,200 per trade to purchase the contracts. So this is what I talked about before. I risk somewhere between 10 to 15% of my account size to take the trade. But then I close out if the position gets to negative 20% of the contract's value. So, and this is actually, sometimes I buy one contract, sometimes it's more contracts. So that's what that means here. So if we break that down a little bit further, we get 1,200 goes to negative 20%. This is equal to, actually it's not negative, it is equal to $960 or negative $240. So the $240 loss is equivalent to that 20%. So if you need to see this again, because you probably will need to, go ahead and rewind this video or just watch it again to understand it, especially if you trade options. Just because options is kind of this mystical thing for a lot of people. And like I said, it took me a while to really figure, or to play around with options, like over a year, to figure out how much I really should be risking. Because in the beginning, I over leveraged. In one of these videos, I talked about how I lost 30K in a week. That was due to options trading. So now that I got this formula, I haven't had that issue. So this is going to be super helpful. So basically, like I said, cut my losses and get out of the trade. So I'm risking 1,200. If I lose, if it's negative $240, then I'm getting out of the trade, basically just cutting my losses and moving on, waiting for another setup or a better setup, or just getting out of the market for that day completely. Just know that this 240, the 240 loss is only 2% of 12,000. That's how I curb my risk when it comes to options trading. So it's still within that 1 to 2% that I talked about for the funded accounts, for Forex, for indices, but this is just a different way of thinking about it. And I pretty much had to had to do a lot of experimenting and lose a bunch of money to find this formula that works for me. So you are welcome. So basically, to summarize, if I'm taking a risky trade, I will only risk 1% for a high probability setup. That may be 2%. And this is typically on average, but generally every single trade, no matter which market or which type of trade it is generally that 1% or 2% max. And if I scale in, then that's when I'm adding 1%, 1%. But for a majority of the trades, I'm not even able to add percentage just because the market structure isn't there. And obviously, I don't want to just put money into the market just to be putting money into the market. So just know that entry before the candle closes is considered risky, but a breakout trade is also risky because it's breaking out. Because if you've looked at the market, you know that there is a high probability for price to break out of a consolidation and then come right back down. I've seen that so many times, and I've been stopped out of positions because of that. But just know that, that is a possibility. That's why we focus on these probabilities that I talked about all the way up here, 60, 70, 80% chance of things working out. So pretty much if you like this video, go ahead and give it a thumbs up and go ahead and watch the other videos here on this channel so that way you can continue learning on your trading journey. See you next time.